find out the difference between ELSS and PPF. What is ELSS? Equity Linked Savings Scheme, or more commonly known as ELSS, is an open-ended equity mutual fund that offers investors the dual benefit of tax saving and income growth. These open-ended mutual funds invest primarily in the stock market. This type of mutual fund has a lock-in period of 3 years from the date of investment. There are many types of savings schemes that can help you earn good returns. But one major advantage of ELSS funds over other mutual funds is the tax benefit it offers under Section 80C of the Income Tax Act 1961. What is a PPF? Public Provident Fund or PPF scheme was introduced in India in 1968 to mobilize small savings. The scheme offers an investment avenue with decent returns coupled with income tax benefits. Let us look at some of the key features of a PPF. A PPF account can be opened with a post office or with specific banks. The current interest rate is 8% per annum, compounded annually, and is determined by the central government on a quarterly basis. Minimum limit for deposit is ₹500 and maximum limit is ₹1,50,000 for each financial year. Amount deposited during the financial year is eligible for deduction under Section 80C. At least one deposit must be made in a year. The minimum tenure of a PPF is 15 years. Here is a quick overview of the pros and cons of investing in ELSS versus PPF. What are the risks involved? The PPF is backed by the Government of India and hence is very safe. Being an equity fund, investments in ELSS are subject to market risks. What returns can you expect? The government declares the rate of interest for PPF every year. At present, it is 8% per annum compounded annually. ELSS returns can vary depending on the scheme selected, but an investor can expect an approximate return of 10 to 15% per annum. In many cases, the returns are even higher, being market linked. A good run in the stock market could reflect in high returns for the investor. What are the tax benefits? The invested amount in PPF is exempt from taxes at the time of investment, accumulation and withdrawal. In case of ELSS, there is a 10% LTCG tax applicable on the profit over and above ₹1 lakh, since the minimum investment period is 3 years. Is there any lock-in period? PPF investments have a lock-in period of 15 years, though after the 5th year, partial withdrawals are permitted. ELSS investments have a lock-in period of 3 years with no possibility of a premature withdrawal. What is the maximum time limit for the investment? PPF investments cannot be made for more than 15 years, though they can be extended in blocks of 5 years if opted by the investor. ELSS investments have no upper time limits. How much can you invest? Anything between ₹500 to $1,50,000 can be invested in a financial year in a PPF, either in a lump sum or maximum of 12 installments. There is no upper limit on investments in ELSS. However, under Section 80C of the Act, only ₹1,50,000 can be allowed as a tax deduction. So, in conclusion, it can be seen that a PPF investment is a relatively safer option, but it offers lower returns and has a longer time horizon as compared to ELSS. The tax benefits are more in favor of PPF. However, ELSS is certainly an option for better returns, provided you have an appetite for market volatility. ELSS versus PPF, which one to choose? Ultimately depends on your personal preferences. Please like, share and subscribe to our channel and visit our website edelweiss.in for more insights on investments.